Hello guys, so today we're going to do kind of an update for the end of this year to come, because obviously as we'll get into the holiday session, my available time for trading and most importantly for educational purposes will be seriously diminished, which means rather than leaving you guys alone, I will just kind of make a global vision of what I expect to do throughout the next few weeks, attempting and assessing the fact that would very less likely going to be available into Discord and stuff like that. So this is what it's going to be. So I'll explain what I will do, and before going any further, this is just once again as educational purposes only, so you guys understand the mechanisms at play, what do I do, and most importantly, why. So this is what this is. We're going to go for a global vision today. We're going to scroll through all of the major asset classes, indices, Forex, volatility derivatives contracts, eventually even some stocks, individual stocks. We're going to go Forex, we're going to go gold, we're going to go cryptocurrencies as well. So lots of things to unpack because there's plenty of stuff to talk about everywhere across these boards. Okay, so first of all, we start with indices, as this is the global things we do care of, into those regular updates in YouTube. So here we go. First of all, I will make a course about these correlation studies later on. It's still in the program for the experienced stuff content, but of course I will go right by the surface of the iceberg today, so kind of scratching the surface. This requires a lot of deeper understanding, but at least I'll try to explain the easier part of it. Okay, so as I'm studying a global cycle of a correlation study, okay, it always takes a full cycle, so you should study from a downside move, then an upside move. In here we can clearly see that the length of the upside move definitely states this as being a trend movement far away from the current previous high points. Not for everyone actually, because we can see that there's definitely two separate words in which one word is in here kind of standing still with an approximate 5% price increase since this market top, and the rally, the nice rally that started since November, but as you can see, just 5% off the previous market highs is not necessarily a crazy move. But on the opposite hand, this fucking guy is just running solo, 20% increase in price on just an over a cycle, which means really top to top. It's really it's not the bottom to top run, which is even more staggering when it comes to Russell. So it's definitely has been a hell of a ride for the Russell. The question is, how long can this thing actually last, and are we on the verge for a reverse? Because as you can see, of course, in this decorrelation study, we do have an increasing spread between the leaders and the laggers, and at some point when this spread tends to consolidate, that generally takes an end for these decorrelation structures. So how far are we from the end of these patterns? That's still a reasonable question to ask, and that's the question I think we're hardly going to be managed to keep up until the end of the year. So I probably think that the end of this next cycle is very less likely going to last till the 31st of December. So it's probably going to happen in between, and that's the major factor I'm monitoring right now into stock indices. Most importantly, not necessarily thinking that when you had an uptrend, you're hardly going to get a V-shaped reverse, unless specific case scenario, which we're not into. So I suspect that we might be terminating this decorrelation phase. Nice trends, but we're probably going to terminate these and enter consolidation phase, leading to probably right before the end of the year. How long is it going to consolidate? You have the approximate length of a general consolidative cycle. So as you can see, it lasts for approximately 2 to 3 weeks. So that's exactly the type of things that we could have throughout the end of the year, if of course we were going for such a thing. So I'm looking at reversal potentials, most importantly because most major asset classes in here showing signs of possible reversals. Some have already at some point even shown reversal potential, like this one. So I'm barely looking at potentially a final burst of energy on these guys, like eventually the French index could be making quite some move, eventually the Nikkei, like a final excessive structure in there, and afterwards everyone will get into sleep mode. So the S&P 500 is doing it. I see quite a bit of an asset that could do it, like a final exhaustion move. I'm not going to bet on this because, of course, I'm definitely not going to buy these exhaustion moves. What I'm looking at is the appropriate timing to sell all of these things and to look for cover trades. Once again, I'm not talking about short selling the market, and we'll get to study this when we'll look at our big boy S&P 500. It's more about what's the appropriate timing to start looking back at cover trading the portfolio, only for those who are experienced enough, because that's a reverse trade and that's also require absolutely necessary bullish exposition to the market, which means you need to have a bullish portfolio, whether that is stocks you're owning for longer term perspectives or stuff like that. Okay, so no net bearish exposition and requires experience to go down this road. Otherwise, that is just something you're not able to do. So just let it go. A reverse trade is not what you want to catch. If the market is building a long-term market top, which is possible, of course, but less likely. If it happens, then we'll get a consolidative structure first, okay? We'll create a range at some point, and then we'll get to break this range to the downside to reverse. So you'll have plenty of time to risk manage and to jump onto the bearish side with less riskier opportunities later on down the road. So Jesus fuck, take your time. Don't be in a rush. I know some of you guys want to catch the absolute tipping top of the market. You're never going to do it. And even aggressive, experienced reversal traders, I mean, we're not looking at it. I mean, we're looking at the reversals not to go bearish, but to cover our past gains, okay? So this is something you probably don't understand. That's the reason why I don't want you guys to get your fingers cut in the process. Okay, so that's what I'm looking for, looking at correlation study. So this is definitely a hard thing to do, and I can definitely see that the correlation is starting to dampen its momentum, which means we're probably nearing the end. So I'm definitely looking at potential reversals, but could be a final burst of energy before that, which means pay attention to momentum. We could see something real stupid before it actually drops out, okay? So assessing that in our risk limitations and management as experienced traders deal with this area, we know that there can be a stupid trade, but we also know that it's not very likely to end up terminating the year at the high point. We're very likely going to get a consolidative structure first. In that perspective, if we study the S&P 500 as a reference, we can definitely see that we're still playing along the same old structures in which we've made wave 1 extended structure, breaking resistances, kind of a late stage move in which you don't think about making huge amounts of money, but looking at overlapping structure. I'm still questioning whether or not we did get a first overlap in here. I think we kind of have done that, and in that perspective, we'll get a reversal in here. And we'll probably get to drop for 20%, which is not going to be the end of the world, but just breaking these structures. We'll get the wedge the wedging structure if that's the case, okay? But we're still far away from this, and I still question this as actually being a consolidative structure, or if this is just the mode of wave, then this is the consolidation, and we're still building the third wave, meaning that we got to have to overlap and then build a final wave to create the typical wedging structure. Okay, so anyway, the only thing I'm pretty sure about is that there is limited upside potential. That's the reason why going net bearish is out of order, but my plan is still to cover the portfolio. I'm currently nearly 100% covered, and I'm still thinking about eventually going a little bit bigger than that, but not now. Okay, so as the market is retracing back to historical highs today, and as we speak, I consider that eventually I need to go a little bit more precise on this, because I still think that we have the exact same wave 1 extended structure on the lower time frames, because we're immediately breaking resistance out of a V-shaped reverse. So I still tend to believe that we're doing the same thing, but in a lower time frame magnitude, like breaking a resistance, ranging, pulling, ranging, overlapping the resistance, and now we're pushing for a final burst of energy in which normally the endpoint is inside the context, okay, but near the trend lines that joins the previous high points. Remember that this is the wave 1 extension alteration of the structure in which the final excess barely gets to overcome the resistant context, generally trades inside but near the trend line. We clearly have the overlapping structures and everything suggesting that yes, we probably are on the verge to terminate these structures. I was looking for a breakout, and damn it, we get it. So we're nearing the end for the S&P 500, and I goddamn think that we're going to reverse pretty much sooner rather than later. It's just a matter of time at that point, but as long as we get to this trend line is where we want to sell. So it's still slightly higher than the current prices, and remember that we've highlighted the 3750 area long ago, so we might just be getting out there without questions with the next few days. This is a 4-hour chart, so it can take multiple days to get there. But I'm definitely monitoring every available 4-hour signals in the nearby area or reversals. Even if we don't have signals, we have the breakouts, we're trading with the trend line. So anytime I see a bearish 4-hour candle, I'll jump on board for a bearish exposition, slightly bearish exposition, of course, and speculative, which means it's not going to risk any more than 2% capital over the bullish exposition cover. Of course, all of those things might sound a little bit technical, but if you don't understand them, that just means you're not experienced enough to go down this road, so just pass on this, okay? This is really reversal trades and only matters for those who have bullish exposition, and even if we get to drop, like I said, I don't think this is going to be an end of the world type of drop. We could find early supports over 3,500, and I hardly think we can drop any further than that. It can be a hell of a drop, and it could happen by the end of 2021, by the end of 2020. Most importantly, because I don't like the way the 2020 candle looks like at the current given time. I sincerely doubt that we're going to get to close this way. Feels more appropriate if we were retracing down to 3,500 or 3,400, putting an upper shadow candle, of course. Still get a positive tainted thing with a positive close over the year, but still we need an upper shadow candle, I think. That's my personal assessment, but of course not for those who have bullish, not for those who don't have bullish exposition to this market. It's really all about covering portfolios, saving the gains rather than irrationally trying to go bearish. Okay, so I hope you do understand that. I'm still bullish somehow for the German DAX. I mean, not excessively bearish. I think this one could suffer, of course, a pullback, but still the reason that we're now trading pretty much at historical highs. So I think we're going to get there first. That's the reason why I think might still have a bullish few days ahead, kind of the final exhaustion we talked about. So it's really more about the broad market sentiment. S&P 500 could go like kind of a blowing off top type of structure in which it goes bullish for stupid reason and then everyone goes down and triggers the reverse. So you know it's going to be harsh to navigate and it's mostly going to be dependent on volatility derivative contracts. So let's switch right into this. So the volatility is where I think there is a game to play because of course as we look for historical highs on the S&P 500, the volatility derivatives still don't go this way, not even to mention that the VIX, which is volatility derivatives on volatility derivatives. It's basically the VIX of VIX. And what we have in here is not fancy at all. As you can see, the volatility is seriously going here, positive in here. Higher low points after higher high points. I sincerely think that there's a burst of volatility to come. I just don't know what's going to trigger it. And of course, the appropriate time frame is still hard to define because I still think right now we're in a range structure that could trigger something ugly later down the road and probably next year, but not now. So I expect still a burst of volatility, but not now, okay? As for now, the volatility remains subdued, go up and down, up and down. I still think that there could be a burst of volatility by the end of this year, trying to look for this resistant context, but it's probably going to be limited. So if you get it right, all of the planets tends to align for one scenario in which we could have a drop by the end of the year, or probably closer to the end of the year, something like 5 to 6% drop, nothing too fancy, just putting an upper shadow candle on the weekly, on the yearly candle, and then slightly later on, probably going to get to retrace to the upside, range a bit, and eventually consolidate further down the road early 2021. But I don't think and call for emergency exit right now, just more like, okay, let's brace for it. First of all, we could get an exhaustion move as we can see that some assets are calling for historical highs like the German DAX and stuff like that. The Nikkei as well could be calling for historical highs. So all of those structures can go on a blow off top, which could be dangerous if you don't know how to deal with these. And because of volatility derivatives still have some room to get up there. And if they fail, of course, that's the reason why I don't buy these blow off tops, but I fear them because we need to risk manage this. And I suspect that the volatility derivatives, if they find some support in there, and they're very likely going to do so, they're going to have a set of bullish waves down the corner, which means we're definitely going to fuck up this moving average. And the next resistance available is the resistant context. So that could lead us to a volatility levels of around 30, which is not the end of the world, definitely isn't. But like I said, with a 30 level of volatility, that's definitely not going to be pleasing going to a tranquility type of end of the year. So I still expect a volatile move to come right by the end of the year, probably limited to 5%, because I hardly think we can go anywhere beyond that. 5-6% eventually. It will probably be pushed into a single day, like really want to mock some sentiment, reverse these things violently. Okay, Of course, that surrounds me what I think with the surrounded smart money management sentiment, which is basically, I'm sorry, there's a bug with this guy. But anyway, you can see that the sentiment is still deteriorating in the smart money industry. But basically, still the same old thing when it comes to dumb money. The dumb money is just going to do the opposite of what the market does. As the market goes up, they're selling. As the market will go down, they're heavily going to buy. So I don't think there is something to plot out of this, just to figure out that if we do have a burst of volatility, I totally suggest that the dumb money will go against it, which means if we have a harsh, violent 3-4% drop in one day, obviously the smart money will go following these movements, going for cover trades, when the dumb money will just go buying stocks, which will be absolutely stupid, of course. Okay, so we've passed this week's catalyst with the Fed. The Fed has just triggered one thing: just keep pushing the dollar down, and we'll talk about that right next when we'll get to the Forex sector, which I think, yeah, let's just go with right now. So I'm still worried about the 10-year yields, still accumulating, and like I said, I think a bearish dollar with yields that might be crossing 1%, and I think that's something that's going to happen anytime soon, then that's going to be an absolutely squeezing structure for stocks, and specifically riskier stocks like these guys, and we're going to talk about these later. That's the reason why I think there is a squeezing pattern coming along the way, eventually preceded by a blow off top, which means this guy could try breaking first, getting the dumb money on board, and then heavily or strongly reverse and fuck up all of those dumb money traders. That's the reason why I think there could be a conjunction of elements leading to these that would be, in the same time, dollar deteriorating but still giving signs of range, which means the dollar somehow getting strength back in as a safer asset demand, okay, like creating ranges, and we're going to talk about that. But most importantly, if this is done in the same time with yields crossing 1%, that would be a definite sign of risk, and we'll see that the USD JPY in here as well is in a very dangerous position that could totally trigger these 5 to 6% very unexpected type of move, kind of a risk-off move right by the end of the year. Everyone thought we would be closing at the high, and we do not, and that's a harsh reverse. Could be volatile, could be totally painful for sentiment, but once again, I doubt we'll eventually get into very dangerous territories. Just violently pull back the supports in a kind of a blow move. After, of course, possibly blow off top first. So expect volatility. We could go up violently on stocks to violently reverse down later on. That's what I think is very likely going to come by the end of this year. Or second option, we do not have the blow off top and we simply just get to retrace. Anyway, I think there's something's going to happening by the end of this year. Just don't know when, and I'm appropriately going to manage looking at my signals, assessing that, of course, could have some stupid volatility to the upside first. All right, that's pretty much about it for this sector. Let's go into Forex. So, of course, Forex, as we deal with the majors, even though the Fed yesterday, we still have a euro dollar going to the upside, I still question the reality on this to actually be managed to be broken through. I still believe that we're going to retrace and create some kind of a range into the nearby area. Nothing too fancy, just probably 23 to 38% fib. And as you can see, that would just be barely retracing into the previous range or going back to the previous supports. Of course, as we go higher and higher, these fibs are rising as well. But I still expect that some pullbacks and ranges might be showing out there as the motive wave is kind of mature right now. And I don't think we have the strength to break this resistance, but that's not that's to forget about the fact that, yes, so far the Fed just keeps pushing, and we've got nothing to answer this in the euro area. It just keeps quiet. So, of course, right now the dollar keeps deteriorating, and I see absolutely no reason for it to stop. All it can do right now is kind of building a range, like save us some time before breaking this level, and I still stand for it. We're going to break these levels in the future. I see hardly no reasons to think it differently. I doubt the triangle to be a possible structure out there. I definitely think we're going to fuck up this area. It's just, I think, a matter of appropriate timing. That's the reason why I don't really think we're going to go straight line. I thought we would go straight line from bottom to resistance, and that's what we've done. But I still think right now, ranging for multiple quarters and stabilizing the post-COVID situation before eventually considering attacking this resistance to break it. Okay, so I still think that the appropriate timing right now to reinforce bullish exposition is not there. Most importantly, I'm doing exactly the opposite. I'm starting to profit take, and I've done a 50% profit taking a few days ago. So that's the thing. Looking on my gains, waiting for a range, for third range boundaries to build, and eventually, when we eventually break those third range boundary later on, I'll get to buy again, but I'm waiting for a range to set up in nearby. Okay, for USD/JPY, this is where there is a huge problem, because like I said, there might be a lot of trouble because as the dollar gets to deteriorate, it's heading back to these supportive area, which is just, oh my God, if we get out there, there is just a falling off the cliff into unseen territory for decade. I mean, we wouldn't have been trading these areas for probably 8 to 10 years. So if we get out there, just look at how illiquid this area is. If we get out there, it's really uncharted territory. Well, it is charted, but it definitely means that it can turn out to be absolutely staggeringly stupid if we get to trade out there. And the high time frame context is pretty damn far away. That's the reason why all of those squeezing patterns we've seen are, I personally think that something real ugly is down the corner on USD/JPY. I just don't know when and if it will trigger. So I'm getting patient in here, and believe me, I've been quite fucking patient, but I'm not invalidating my scenarios anyway, because I still believe that there is a huge blow move to show up on the USD/JPY, possibly even next year. I don't know. If what I expect for the end of the year is just going to bring us out there, which is the major support, and I don't know if we're going to just break it like end of the world type of scenario, or if we just somehow build a support, break a resistance, range a bit, and later next year get to attack this level. I just think we're going to break it. It's just a matter of time. It's just, I don't think that the volatility I expect for the possible market behaviors of the end of this year, I don't think it's enough to actually trigger such a big thing. I think we're going to save this for next year, possibly. But we could go right there, testing the trend channel and violently rebouncing. Really like a short-term move, exactly what I think about. Really risk on. USD/JPY, 10-year yields crossing 1%, everyone thinking that the end of the world is there, but we're just terminating the year, and this has been hell of a bullish year anyway. So I think more of a cover trade to push prices back to supports, terminate the year, and start a new fresh year later on. Okay? So that still is my personal favorite scenario at that point, though I'm looking at early signs of activity into 10-year yields and USD/JPY right now. USD/JPY is definitely going down my scenario. I am already fairly leveraged into this market, so I don't really want to reinforce, but I'm really having to target these areas where I suggest you guys put some profit-taking structures, because of course, if you forget about limiting the markets, well, these things can go real fast. Real fast. Okay, so it's the kind of thing that can happen overnight, and you wake up in the morning and you're right back in. Okay, so pay attention to this. Anyway, EURJPY in the same time doesn't really give us any information then. That's the problem. That means dollars deteriorating every other major currencies, euros and yens included. And in that perspective, I'm still questioning the fact that we could have an advantage coming from yen, which would push euro yen to the downside. That's what I think, because I think a limited potential on euro dollar, where there is really an enormous trap below our feet on the JPY indexes. So I'm really questioning the probability of a harsh, violent move on EURJPY before reactivating and, of course, pushing further. So we'll see all about it. It's just an assumption I've made, or we can just do it that way. Like we said, a first blow-off move, then we retrace back there, and we keep a major move in here for next year, in which we go really low, eventually breaking these low points, which is not necessarily going to happen and stuff like that. But we'll see. There's plenty of things to talk about next year. It's really all about trying to forecast what's going to be probably showing up by the end of the year. And I still tend to believe that, yes, cycle alignment in here. I think something's going to show up on the yen that will not necessarily happen on the euro. Okay, so I think, yes, looking for a market top in here, looking for a fall off a cliff USD/JPY eventually. Probably short-term catalyzed volatility could trigger such a thing. Okay, now other asset classes. Gold, I totally fail on this one. It's definitely, I mean, I was looking at prices slightly lower than that to get in, didn't got them. Now we've reactivated, we're going for validation level. I still question whether or not this is going to be a success. I hardly think we can break these levels. Remember that in here, the third range boundary is right there. So we need to break this level. I think that what we could see actually in here is just eventually going out there and retrace later on. I don't think gold is going for a bull run anytime soon. I think we just build a bottom because this was stupid to sell gold. But I still don't think this guy is mature enough. Though I'm waiting for more appropriate structure, I think there's no rush and no reasons to rush and buy below a resistance trend channel. More importantly, waiting for further informations. Either we break it and we're going to get a positive channel which is going to reverse, and in that perspective I'll be willing to catch eventually a third range boundary. So I think there's no emergency getting into gold. I think volatility could still show up, and this guy should still remain inside this range. Hard to say whatever the structure will look like, but I hardly think we can sustainably break to the upside. So I think I've missed the bottom, which is no big deal. I mean, catching the bottom of a range is not necessarily my favorite choice in this market. It's more about if I want to trend follow gold, if a trend eventually emerges, then I really want to do it with a limited risk, which won't be the case if I'm buying a resistant context. So I have missed the shot. I was waiting for a pullback in here as well, and I missed it. But that's it. I mean, when you miss something, you just don't have to be dumb enough to try catching on something you've missed. So I totally missed the current shot, and eventually I just missed the shot all by itself. That's a possibility, and if that's the case, no big deal. We're still inside a range, and I don't want to be stupidly aggressive inside these structures. Okay, so that's for gold. Now next, we need to talk about the stocks. So Apple is trying to break the third range boundary, and like I said, this could be the potential for a blow off top, in which a few assets could go really stupid before bursting all of the energy, because once again, anytime Apple retraces down to this level, I'm going to short the hell out of them, and not just a little. I'm currently very little exposed to this market, very limited bearish exposition. This is speculative exposition, basically. And I'm looking at reinforcing this exposition if we ever retrace back to supportive area, because all of this is not a support. All of this is just something that is a cracking floor. We're definitely going to fuck it all up if we get out there. I just wait for the appropriate timing in which this could eventually happen. So far, it doesn't. So as long as it does not happen, I'm willing to take the blow off top as a loss. And that will obviously be a loss for me if it breaks up. But like I said, I don't really fancy that thing, and I don't really believe in it. I think it just can be short-term expectation, really absolutely staggering, stupid speculation that will, of course, blow very violently later on, because this guy sure can make another additional 20%, can also lose easily these 20 to 25%. So that's the reason why I'm getting cautious on this guy, certainly not trading these aggressively. I still am bearish on this guy. I know the risk I'm taking. I know how dangerous that is. None of you guys should be following me on this. It's really absolutely expert context, and I'm using this as a cover trade for my bullish exposition. It's more I'm using the beta of Apple, because this guy I know is going to be volatile, and it's definitely going to be the one that's going to lose the most if there is a volatility burst. If there is not, and if we go for a blow off top, it's also going to be the one that's going to gain the most, because that's the stupidest asset at the moment. Apple is no longer a tradable asset. It's just the sentiment all by itself. If we want to go stupidly high on a stupidly bullish sentiment, trying to gather dumb money on board, this is definitely this asset that's going to do it. I mean, Apple is fairly crazily overvalued today. It's definitely not going to be that cheap, that expensive later in the future. But right now, people just don't want to think about it. They just want to make some easy money on something they know. And Apple, they know it. They don't buy the product, but they think Apple is great, and they're going to always be great, which I sincerely doubt. But anyway, okay, that's a topic for another day. Amazon as well is one of the concerns I have right now, trying to break the same resistance. So you definitely see that for a blow off top, we already have all the candidates. All of these guys are probably the one that could go real stupid, making 20-25% upside move rapidly, and that could shift up indices toward breaking resistances on an absolutely stupid move. But the thing is that if they fail, there is eventually the exact same volatility on the opposite direction, and even more to the downside. So that's the reason why I really want you guys to be cautious by the end of the year, not trading any of those assets. This is really experienced professional stuff only, because that's going to turn out to be real stupid, and I know it. It's just that it can go up before going down. It can go down. It can do anything in between. It's absolutely unpredictable. It's going to be stupid volatility. I'm just using these assets as better coverage in my portfolio, which is something you just don't know anything about. I definitely don't want you guys to say, all right, the guy is selling Apple, it looks like he's good, so I'm going to do the same. Jesus, fuck. I'm doing it into a global portfolio management. It's something that I definitely cannot explain right here. Okay, now finally, let's go down the crypto sector. Bitcoin, oh man. So let's switch to a crypto analysis. perspective in here. So Bitcoin has done its own personal blow off top. It is blowing up the 20K area with a fancy move. Okay, BTC dominance still doing great because of course Bitcoin is the leader. The total is going up. Ethereum is following, and the others are kind of some are lagging, some are doing fancy. Like the Litecoin has catch up on these fellows, and it's taking the lead in here in the group sectors in here, and we see the laggers that absolutely fail to find some interested investors. So we start to see divergence toward the global crypto sector, which means some assets take the value and take investors' interest, some other do not. And that's something I like. That means that we're finally not just buying it all, we're finally getting picky on the assets we want. If we have a look at the global cyclical activity in here, we're still fairly much going bullish in here. An intermediate consolidation has gone on, and the question is, have we actually even made a market top in here? I think we did. The question is, maybe we've already terminated the consolidation structure. I'm still actually questioning this because maybe this was just an intermediate consolidation, some volatile, stupid thing, and we might just be keep on pushing this previous cycle. I'm still questioning whether or not this is truly happening. So I'm just questioning this. It feels a little bit quicker as a consolidative structure, but probably still can be something like that. We've seen significant drops on some assets. So yeah, I mean, future will tell if this was insignificant. That mostly depends on what's coming next. But right now, I'll consider it significant out there. So in that perspective, we would have been terminating this consolidative structure, pulling back to restore the trending behavior. That would be the possibility. If we have a look at individual assets, yeah, so Bitcoin is breaking and finally pushing beyond the breakout target. Remember that this breakout target is from this historical highs and the lowest candle close preceding the latest context retracement, which is actually in here was both validation and confirmation, because as we generally break out, remember validation is the trend channel. The last time we touched the trend channel, which is in here exactly the same area in which we touched both trend channel and context. So in here we had validation and confirmations at once, and that was the level of 20K. We're now seriously breaking above it. It's hard to say if we're going to maintain price over it. I still believe we are, and there are likely probabilities for this to come. But of course, I think we've made all the potential. So I still believe that right now, boring ranges on the verge to show up later on. We can hardly keep up that momentum for long. So, I mean, we can do it for longer, but that would be just stupidly going parabolic as we did previously, which I don't think it would be a rational outcome. I'd rather like to see Bitcoin right now consolidating on top of the 20K and keep rising, keep pushing. 25 as an area of interest in which I'll start looking at potential cover trades. That was the plan, remember, for this. So I think in here we're going to have to slow down and after risk managing this area, probably keep pushing or retracing. All of those options are fairly probabilities, but I think something going to happen in here, but not by the end of the year. So to be honest, to me, cryptocurrencies have been the 2020 assets, and there's not even a question about that. It's just the absolutely staggeringly higher returns we've had for the year. And yeah, let me be honest, I really wasn't thinking about that. I was thinking about the fact that cryptocurrencies might be some of the bullish assets throughout the years. Definitely wouldn't have thought they would be leading, and by far. So yeah, I think there is a lot of potential, but it's also the thing that if we burst all the gas immediately, that would be absolutely stupid. I wish these assets will take the time to create trends. See, if they want to really go on much higher territories, they will have to do such a thing, to go calm, to go easy, instead of just going bold and stupidly high. Okay, so calming down and building the trends, which means creating intermediate range structures and breaking these as a trend follow opportunity. That's what I'd like to see. I've made a podcast about it into trading view, so I'm not going to say it all over again. What matters to me is not Bitcoin, actually. What matters to me is the dominance play out. Because of course, if we have a look at this, we can definitely see that there is a trend line, there is a resistant moving average in here. I definitely think that these are the most appropriate areas to use your Bitcoin as speculative assets for the rest of the crypto sector. Basically, spreading out your Bitcoin gains to make more of a diversified portfolio and stuff like that. And that's really the point in which I think in here Bitcoins are way too expensive regarding their actual use in the real world. I still doubt Bitcoin is going to be a currency for the world. I still think Bitcoin is an introduction to what's going to be the future of blockchains and not cryptocurrencies. Though I still tend to believe that the growth potential is on altcoins rather than being into Bitcoin. Reason why in such expensive levels of dominance, I would like to see the Bitcoin spread it out into speculative growth portfolios. So that's something I'm bearing in mind for the next few days. At 66, we definitely are dealing with a resistance. But remember that as we build this market bottom, and I think this is a market top, we're still ranging in between, and I've been real clear the last time, this is not something for the end of the year. I still suspect that a long boring range is going to happen in here. I just don't know which structure it's going to be like. So I think this area is an area of spreading out the gains, and I would like to see this happening. I'm not actively trading this because what I'm looking at to figure it out is the ETH BTC spread charts most importantly. And as you can see, this guy is still ranging as well. So I expect this guy to keep creating some kind of the same range as the dominance, in which later on I suspect it's going to massively break this level, but it's going to take time. It's going to be throughout next year. So we're going to have plenty of time to talk about it. I'm just looking at the same old supports that for now are just holding on. So I think that this plan is really at play. Bitcoin is slowly but steadily shifting into distributing the money into other assets, but it is something to monitor. Of course, I'm definitely, and that will be my thing for cryptocurrencies for the next few weeks till the end of the year, looking at the fact that the dominance still stands within the boundaries I wanted to stay into. So that's mostly all about it. Do I have invalidation theories on my Bitcoin dominance visions, or do they keep the pace I expect, which is just a boring range in which we oscillate? Okay? So that's pretty much all about it. I'm mostly looking at arbitrages in the crypto sector rather than looking at bold value of these assets, because I think Bitcoin can turn out to be stupid, and it definitely proven to be over the latest 48 hours. I wish I could see this one building more of an intermediate structure, but it can also keep pushing right into the 25K area and then range out there. So I definitely don't fight against it. I was really clear. I didn't profit take the 20K area. I didn't profit take the 600 area on Ethereum because I absolutely see no evidence of doing such a thing. I think that right here we should have the signals I'm looking for, but this is just going to be intermediate risk management, so probably arbitraging to create ranges more than anything else. So I'm waiting for ranges to show up into cryptocurrencies rather than going stupidly to the moon parabolic. I'm not going to fight against it. If that's the future, I'm just going to go along with it. But I'm going to arbitrage the portfolio and look for cover trades into this area, definitely. I wish this will happen, because normally if the smart money is really in, they're going to have to risk manage this area. Okay? That being said, that's pretty much going to be all about it. So for my crypto sector and for the next few weeks till the end of the year, I'm just monitoring Bitcoin dominance and every daily signals we could have as we approach this area with crypto Bitcoin. So I doubt we can break this breakout level. I think that what we can do instead is just trying to get closer to it and then range. So I'm looking at new ranges to build. Just like we've built a range, we extracted out of the area, I suspect another range is going to come just to catch up on the trend lines, catch up on the moving averages and stuff like that. Basically, trend following opportunities. Okay, we definitely had trend following patterns triggering here and here on Bitcoin, which is a really, really good information to process, because that means if trend follow patterns work out, if we break through targets, that means we probably are building trends on cryptocurrencies and specifically Bitcoin. So I've talked about it and the probability of this. That doesn't mean the probability of a violent pullback out there is to be avoided. It just means that the more we have information coming for us, the more it suggests, yes, the trend is probably already at place for Bitcoin, and we really would like to trend follow it, which means anytime there is a range and retracement, this is going to be an opportunity to try reinforcing bullish exposition and trend following this thing, rather than trying to think about an inevitable pullback of 40-45%, whatever. These things could just not happen at all. So I think it's an appropriate time to start risk taking on Bitcoin, slowly but steadily going to trend following patterns. Not just on Bitcoin, but like I said, as I think there's going to be a boring range on arbitrage, it can be done here, and just don't trade Bitcoin itself. I think you can trade everyone in here. Doing not leveraged position, don't be dumb enough to go leverage. You can use margin, but don't be leverage positioning too much, okay? So tiny little leverage are possible associated with stop losses, and you know how stupidly volatile these assets can be. So the higher the leverage you use, the shorter the stop loss, the stupidest trade you will make, because you can be taken down by ugly shadows on exchange-based speculative attacks, okay? So just stay safe. Margin trading, I think, is now usable on cryptocurrencies, but do it safe, do it smart, and don't be dumb enough to put the stop losses right below supports, okay? Just try to do it right below supports, but keep it a little bit of a safe margin, because these are cryptocurrencies and we still know how dangerously volatile they can be at some point. That being said, I wish you guys a pleasant end of the year. Nice holidays to all of you guys. Take care of your families. Enjoy some times, whatever. Do whatever the fuck you like. Remember that trading at the end of the year can be volatile, but it can also be just as boring as possible. So as for now, it goes for the very boring type of state. I doubt it's going to last till the 31st of December, so expect a little bit of volatility, but the best things you could do is just getting prepared for it. And if it happens, you just stop being a pretentious prick and saying, oh man, I'm making a shit ton of money. Just prepare yourself. So if you have bullish exposition on stock markets, I think eventually upon confirmations only, which means the experienced traders will have to give you a green light before going down this road. Just know that you will eventually have to look for covering the portfolio for a potential 5 to 6% drop on global asset valuations. But you also know that this can just be on these assets and not necessarily impacting the rest of the market. I think it can impact small and mids. So these are the areas in which, if you are heavily exposed to the upside on Russell 2000 stocks or in the top 5 big stocks, then if you have these guys in your portfolio, you might eventually consider cover trades if the shit really hits the fan, and that's really a big if. So don't try to anticipate it, but look for it. And that's probably the only job you're going to have to do by the end of the year. Regarding at cryptocurrencies, the 25K area is an area as a range probably going to build. So look for potential reversals as well for those who know how to handle this. And if there is no such a thing, then just wait for prices to get there and you'll get third range boundaries to trade. So just let the market go up and wait for the third range boundaries. Remember that there are so many opportunities. Just trying to deal with these, you know how to navigate. So if you're learning my strategy and getting started with it, Jesus fuck, don't go again into trying reversals and stuff like that. You're definitely not prepared for it. So try to be rational and wait for these reversals to take place and just try to catch up on the following third range boundaries. That being said, yeah, wish you guys a pleasant end of the year. I'll be less present into Discord and stuff like that. I'll try to be there if there are really things to talk about. I'll try to record videos like this one, but this one is like the safe ground for me. So I know if I don't have time to record, at least I've said what I think about the market right now and what I expect for the next couple of weeks. Bye guys, have a nice holiday.